My name is Michael Grandy. I'm a professor at Providence College, and I'm teaching an MBA course this semester on managerial accounting. It's referred to as MBA 603. And we're working on cost, volume, profit. This is chapter 5. We're going to look through two problems. We're going to look at problems 5-22, and we're going to look at 5-21. For my students, the solutions have been uploaded to Sakai so that you have them. But what I want to do now is I want to read the problem, which I assume you have the textbook in front of you, and go through the solution on the screen. So let's first look at 5-22. And it says, due to erratic sales of its sole product, a high-capacity battery for laptop computers, PEM has been experiencing financial difficulty for some time. The company's contribution format income statement for the most recent month is given below. So you've got an income statement here, a contribution format income statement, where the company is currently selling 19,500 units. The sales price per unit is $30 a unit, having total sales of $585,000. The variable expenses, which are also based on 19,500 units. That's an important concept, because remember, if they're going to sell 19,500 units, the variable expense has to also be based on 19,500 units. They don't give you the variable expense per unit, but you can easily calculate it by taking the total variable expenses and divide it by the 19,500 units that are being sold. They've got a contribution margin of $175,500. They've got fixed expenses of $180,000, and guess what? They're losing money. So the first part of this question is asking you to do what? Compute the company's contribution margin ratio and its break-even point in units in sales dollars. And I've indicated to you earlier, I like to use the formula method when doing this. So let me share my screen with you, and you can see the solution. So what's important here is calculating the contribution margin ratio. And as I've indicated earlier in our PowerPoint presentation, you can do this on a total dollar basis, and you can do it on a per unit basis. The total dollars come right from the problem. Contribution margin is $175,500 divided by the sales revenue of $585,000. The CM ratio is 30%. But here's some other information that's important, right? On a per unit basis, they told you the selling price was $30 a unit in the problem, but they did not tell you the variable expense per unit. But you can calculate it by taking the total variable expenses divided by the number of units sold, come up with $21. And therefore, the contribution margin per unit is $9. And on the right-hand side, you can see on a percentage basis. The sales number is always 100%. The variable expenses, $21 divided by 30 is 70%. Contribution margin ratio is $9 divided by $30 is 30%. Second part is asking you to calculate break-even point in units. BEP units equals fixed expenses divided by the contribution margin per unit. Fixed expenses they gave you in the problem is $180,000. Contribution margin per unit is $9. Break-even point in units, 20,000 units. We're also asking you to come up with break-even point in sales dollars. But before we look at the formula, if you know the number of units to break even, and you know the sales price per unit, can't you calculate break-even point in sales dollars, number of units, times sales price per unit? You can do it the way I just said it, or you can use the formula. Break-even point in dollars, break-even point in sales dollars equals the fixed cost divided by the contribution margin percentage. $180,000 given to you divided by 0.30, that's the percentage converted to a number, $600,000. Very straightforward. That's the easiest way to calculate break-even point. Next question, question number 2. Compute the president believes that a $16,000 increase in monthly advertising expense, that's a fixed cost, right? Monthly, not per unit, monthly, combined with an intensified effort by the sales staff, will increase unit sales and the total sales by $80,000 per month. So total sales will go up by $80,000. If the president is right, what will be the increase or decrease in the company's monthly net operating income? So what's happening here? There's a lot of different ways to solve these problems. This one's very streamlined. What's the increase in the contribution margin? So if you know the increase in sales dollars and you know the contribution margin ratio, you don't need to project out total sales. You don't have to project out variable expenses because you know that the contribution margin is 30%. So that means for every dollar of sales, 30 cents results in contribution margin. 30% of every dollar results in contribution margin. So if sales increase by $80,000 and the contribution margin is 30%, that means 30% of $80,000 or $24,000 is the increase in contribution margin. Contribution margin minus fixed cost equals net operating income, right? So contribution margin increased by $24,000. Advertising expense in this example goes up by $16,000. So there is an increase in the monthly net operating income by $8,000. Let's remember this. They were losing $4,500. This plan for improving profit increases net income by $8,000. Resultant net income, $3,500, right? Loss of $4,500, increase of 8, positive $3,500. Let's look at item 3. Refer to the original data. The sales manager is convinced that a 10% reduction in the selling price combined with an increase of $60,000 in monthly advertising will double unit sales. If the sales manager is right, what will the revised net income or loss be? Let's read it again. Sales manager is convinced that a 10% reduction in the selling price. So the selling price per unit drops by 10%. Doesn't this have an impact on contribution margin? An increase in $60,000 in monthly advertising. So fixed costs are going to go up. And they believe they'll be able to double unit sales. So sales price goes down, means contribution margin goes down. Fixed costs go up, but they're going to double their volume. What's the impact on net income? So again, their solution is pretty streamlined here, right? So sales are going to double. Remember, quantity and price. Number of units multiplied times the sales price per unit. They were selling 19,500 units. They're going to double them. They're now going to sell 39,000 units. But the sales price is not $30 a unit anymore. It's only $27 because they have a 10% cut. The sales price was $30. 10% of $30 is $3. The new sales price is $27 per unit. $1,053,000 in total sales. Subtract variable expenses. Now remember, there has to be parity between the number of units sold and the number of units you base your variable expenses on. So the variable expenses also has to be based on the double number of units, 39,000 units. The variable cost per unit stays the same at $21, doesn't change. Contribution margins, now $234,000. But fixed costs go up. They were $180,000. They added $60,000. New fixed costs, $240,000. New net operating losses, $6,000. They're now losing $6,000. They were previously losing $4,500. This scenario increases the loss by $1,500. Not a very good plan for improving profit. Let's talk about number 4. Again, refer to the original data. The marketing department thinks that a fancy new package for the laptop computer would grow sales. The new package would increase packaging costs by 75 cents per unit. So variable costs go up. Assuming no other changes, how many units would have to be sold each month to attain a target profit of $9,750? So this is a target profit calculation. So remember, the formula for target profit is basically the same as break-even point in sales dollars. Sales dollars to achieve a target profit is the target profit plus fixed expenses divided by the contribution margin per unit. The target profit, $9,750. Fixed costs are $180,000. But the contribution margin per unit changes, doesn't it? It was $9. They added 75 cents to the variable cost. The variable cost was $21. They added 75 cents. The new variable cost is $21.75. The new contribution margin per unit is $8.25. They need to sell 23,000 units in order to have a break-even point. Let's read number 5. Refer to the original data. Refer to the original data. By automating, the company could reduce variable expenses by $3 per unit. If the variable cost per unit goes down, the contribution margin does what? Goes up. However, fixed costs would increase by $72,000 each month. Number 1, compute the new contribution margin ratio and break-even point in units in sales dollars. So here's the new contribution margin per unit, right? The sales price stays the same at $30. The variable expenses go down, right? It says what? Variable expenses would be reduced by $3. So they were $21. I'm going to subtract 3. The new variable cost per unit is 18. The new contribution margin per unit is 12. And of course, if you change that mix, the contribution margin ratio changes as well, doesn't it? And you can see the new number. The contribution margin ratio is now 40%. Calculate break-even point in units in sales dollars. The fixed expenses go up, right? By 72,000. The new contribution margin ratio, new contribution margin per unit is $12, right? Got that right from there. They now have to sell 21,000 units to break even, and they have to sell $630,000 in total sales to break even. Should be able to calculate break-even point in units and sales dollars. Part B, assume that the company expects to sell 26,000 units next month. Prepare 2 contribution format income statements, one assuming that operations are not automated and one assuming that they are. Show data on a per unit and percentage basis as well as in total for each alternative. So not automated, automated. The not automated is what? The original scenario, right? With regard to sales price per unit and variable cost per unit with that same 30% contribution margin ratio. The only difference is what? They're selling 26,000 units at $30 per unit. On the automated basis, you got different numbers. On an automated basis, right? The contribution margin ratio increases to $12 per unit, but the fixed cost go up by the $72,000. So you can see by automating, what happens? Profit goes up by $6,000. Now, my handwritten scribble here is an alternative way to get there. You don't necessarily have to do that one, but you can see it's a little bit more streamlined, right? So on an automated basis, so this is what? Quantity times price. Looking at the contribution margin only. So on an automated basis, they're selling 26,000 units. The contribution margin per unit those numbers are wrong. Ignore that. Okay, ignore that. It still works, but I didn't use I should have used the contribution margin per unit. Okay, apologize for that. So just go with this scenario here. This is how they asked you. This is how they asked you to answer the question by preparing the contribution format income statement, not automated and one automated. Okay, let's take a look at exercise number 21. So let's read exercise 21. It says, Gold Star Rice, a Thailand exports Thai rice throughout Asia. The company grows 3 varieties of rice, white, fragrant, and Lunzan. Budgeted sales by product and in total for the coming month are shown below. So they have 3 different products. They have total sales of $750,000. And you can see they have a certain sales mix. Their sales mix scenario, 20% white, 52% fragrant, 28% Lunzan, for total sales of $750,000. They currently have a net operating income of $30,000. They've gone forward and they've calculated the break-even point. We've talked about that during our PowerPoint presentation, that when you have multiple products, you have to calculate the weighted average contribution ratio, which you look at it on a combined basis. And you can see the combined basis, contribution margin ratio is 64%. $480,000 divided by $750,000. So their sales dollars to break even with that given sales mix is $702,000. As shown by these data, net operating income is budgeted to be $30,000 for the month, and the estimated break-even sales point is $702,000. Assume that actual sales for the month total $750,000 as planned. However, actual sales by product are $300,000 for fragrant, $180 for $300 for white, $180 for fragrant, and $270 for Lunzan, which is a different sales mix. So first thing it says is prepare a contribution format income statement for the month based on actual sales data. Present the income statement in the format showed above. So here is the solution here. And what's important to remember here is the variable expense percentages and the contribution margin percentages for each product have to stay exactly the same as the given problem. So what you see here is the sales are provided for white, $300,000 from the problem, $180 for fragrant from the problem given, and Lunzan from the problem. So the sales mix is different. But let's remember, the variable expenses have to stay the same as a percentage. If you look at the problem, it said white had a 72% variable cost expense. You need to use that in figuring this out. So you got $300,000 in sales for white, 72% is the variable expense percentage, and therefore 28% is the contribution margin percentage for white. You got $84,000 contribution margin. For fragrant, again, they gave you the $180,000, but you needed to use the same exact variable expense percentage and the very same exact contribution margin percentage for fragrant at 20 and 80. The same thing for Lunzan. Add the numbers across. You got $750,000 in sales, which they gave you. You therefore have $360,000 of variable expenses and a resultant $390,000 of contribution margin. The fixed costs stay exactly the same. Those don't change at $449,280. But now they're what? They're losing $59,280. Why? Because the sales mix changed. What happened here? Let's look at it and ask why. In the example, the original sales mix, the white rice represented 20% of sales. It only has a 28% contribution margin. But look what happened. The actual sales were double. So instead of 20%, they're now 40%. That dragged it down. That contribution margin of only 28% dragged down the overall profit of the company because the sales mix was off. Let's read item 2. Compute the break-even point in sales dollars for the month based upon your actual data. So again, when you have a multi-product sale, you need to use the combined contribution margin ratio. You have a combined contribution margin ratio of 52%. Fixed expenses divided by the weighted average contribution margin, $864,000 is the break-even point, which makes sense, right? Because they're losing money at $750,000. They're losing $59,280. So therefore, total sales have to go up so they break even and get to zero. Wouldn't worry about the third part of this problem. Feel free to read it. It's in Sakai if you'd like, but we did chat about that a little bit. So let me stop sharing that. Those are the problems. We'll come up with a synchronous problem in class. Thank you very much.